Good afternoon. George Cavaligos for Dragon Slayer newsletter. Well, guys, I don't know what to say. What do we know at this point? The 10-year and the bonds both look like they have five-wave structure from the highs at Wednesday afternoon, Thursday morning, right around 131.24. We got down to 131.12. We highlighted that 130, 11, 12 area as a big confluence of Fibonacci retracements this morning and wanted to cover shorts. We put that out in the tweets and in the email this morning. I pray that if you didn't cover most, if not all of your shorts, that you are moving your stops down. As time goes by and we have short positions from good levels, we keep moving our stops down. I don't know if I was aggressive enough in moving my stop down. I think in the last email or last tweet I said the stop should be above 130.27 plus. That's a big level. That's a previous fourth wave. The market should bounce back up there. And a lot of times we'll go back up there as we're doing these big corrective patterns and go through there and take out stops. Now, in the emails yesterday and this morning, I highlighted the fact that the Fed is actually net draining liquidity by selling, I think, a net 13 billion more in treasuries, all the short-dated stuff, than they're buying this week. And it's the first time in quite a while. And I sent out that Tom McClellan's newsletter. They highlighted that fact to me, and I hope you guys saw that and read it and listened to it, because it's important. Now, the only thing is, what do you know? The Fed's been adding a lot of liquidity, and I think what that's done, if you remember the chart I sent out a couple days ago with the overlay of the bonds and the S&Ps, last May when stocks were up at this level, bonds and notes were a lot lower than they are right now. Operation Twist, or whatever you want to call what the Fed's doing right now, has obviously succeeded in keeping stocks up, bonds up, and notes up. We didn't see the big jump in interest rates like we saw last spring this time around. Once the Fed's done with this, and the schedule is supposed to finish in June of this year, so we got a couple more months of this nonsense, we could be chopping around up here near these highs. Now, if you look at the daily chart, I'm going to try and put this down, and I'll send that out probably tomorrow morning. But if you look at the move down from 132.11, we went down, up. We had the high at 131.24, and now we went down to 130.12. Is that 1, 2, 3, and we're going to go into a big fourth wave correction and then break again? Or was that A, B, C down, and now we're going to go back and retest the highs? We don't know. Elliott wave gives you probabilities. We see five-wave moves down. That tells us that typically the direction of the trend is that way. The problem I'm having is we're not seeing the third wave, which is this last rally down, being much longer than the first wave down. They're pretty close. They're pretty similar. So either we need more downside to confirm that this is a third wave down, or this is a C wave down, which would imply that we're going to go back and retest the highs again. We don't know that yet. We're going to take this one day at a time, one step at a time. We caught a nice short trade from Wednesday afternoon of last week through this morning. We've covered. I just sent out a tweet. If the market dips a little bit here, we just saw a rally up on the notes and bonds, and we're getting some very short-term divergences on this last leg of the rally. That's why I said I think it makes sense to wait for a pullback down to some previous highs and lows around 130.17. If it holds there, I'm going to try a long with a tight stop, and it's going to be a small long because of the five-wave structure that we're seeing on the downside. Typically in Elliott wave, you want to go and trade in the direction of the five-wave moves to limit your risk and maximize your gain. I'm more concerned about minimizing risk than maximizing gain at this point, because I think we're still up in some massive corrective pattern up here near these highs. And the bonds and notes could be stuck here for quite a while. You know, the bonds could be, 140.5 to 146.5, and the notes could be, 129 3/4, that 129, 25, 26 low that's so important, up to 132.5 for quite a while. And we just, we won't know that pattern is complete until it shows us some more signs of, either much bigger third waves, confirming the fact that it's a third wave down instead of a possible C wave corrective pattern. It's just not clear right now. So we're going to try and minimize risk. We're going to pick up some nice trades like we saw from Wednesday to Thursday. And if we get a dip tonight, we go back down. I think we will. We have 2 more auctions. We have, 5 years and 7 years tomorrow and Thursday. The Fed is actually doing a small buyback tomorrow in the long end. So that's another reason to try and play the long side here. I think if we can get a little bit of a dip tonight and the 10-year goes back down to 130.17, I'm going to try and buy it there with like a stop below 12. Looking for a bounce back into tomorrow's buyback. Next day they're going to be draining again. And that'll be the 7-year auction, which is typically not a good, well-received portion of the curve. So we got a game plan. We're going to try and be careful now. We had a great run from, like I said, from Wednesday to this morning. It was, 2 points and little risk. I don't think we took heat at all on any of the trades if you followed my trades over the last 5 days. So nice job. Sit on our hands a little bit maybe and trade 1 lots instead of 5 lots at this point, or 2 lots. But we're going to try that long right around 17, and I'll put the 12 stop in tonight. That'll be my plan for the overnight trade. If I miss it, I miss it, and we'll look for other opportunities tomorrow or tonight even if we get some clarity with this picture right now. Whew. What else? Gold, massive rally. A lot of talk. I hope you saw the thing about the ECB LTRO. They're hinting right now that they would like to make the one that's, I think, February 29th is the next big LTRO, where the ECB loans money to the European banks for like nothing forever, and the banks reap the benefits of that. There's also the Beckner piece that went out this morning hinting that even with economic growth that we're seeing over the last couple months, that the Fed is still leaning towards QE3. I think they might be trying to set the political table in front of the June expiration of this Operation Twist program. We'll see. We got time. They're saying that if inflation isn't over 2%, that they still could do QE and keep their balance sheet up here. It's crazy. Somebody's got to pay all that debt back sometime, guys. All right, guys. Have a great night. We will see you tomorrow morning in the email, and if anything pops up, obviously, we'll throw out some tweets.